Good afternoon. My name's Rob Murphy. I'm head of investment companies at Edison. Today we're presenting Riverstone Credit Opportunities Income Fund. This is an $80 million UK listed fund. They recently announced a dividend at the last set of results of 2 cents per share, which puts it on a healthy 9% dividend yield annualized. And today I'm delighted to have the two co-heads of the Riverstone Credit Platform, and they're both partners of the of Riverstone. We have Christopher Abbate and Jamie Brodsky. Welcome.
Thank you. Thank you. Nice to be here.
Great. So I'll call the fund RCOI because that's a little bit shorter. It's a little bit different to many investment companies. It's in a niche area of energy infrastructure loans, which appear to generate pretty high returns. So, maybe you could kick off with what do you see as the investment opportunity in energy infrastructure loans?
So Jamie and I came to Riverstone about 7 years ago to build a credit business. Previously, we had been investment bankers providing capital to the energy sector broadly. And we really saw a gap in the market appear. The capital markets wanted bigger and bigger transactions, both in terms of size of the companies, but also size of the tranches for liquidity purposes. And meanwhile, the banks really started to retrench on small and mid-market lending. That was really driven by regulatory changes after the financial crisis. So a growing gap in the market began to appear. We call it the wedge, and it really was something that was not being serviced by other providers. At our banking seat, we could go and find plenty of convertible preferred equity, mezzanine debt. But really what the banks, or what the companies wanted rather, was first lien unitranche loans that could be repaid once the project was finished and put into service, and there just wasn't anybody out there doing it. So we pitched the idea to Riverstone. We jumped on board the platform in 2014. Raised our first private fund in 2015, and since then we've raised over $2 billion for the strategy, including RCOI, and have put that to work in the wedge, and I think it's been quite successful. Since then, what we've seen is a transformation along a number of lines. I think the capital markets have only gotten more interested in larger transactions, so a high end of our range in terms of what we can do is increasing. I think the banks have been retrenching as well, and one of the factors causing the banks to retrench has been ESG concerns, and what that is, I think, led to, frankly, is a wide open playing space for us. But we, of course, are concerned about ESG issues as well. And what we've seen is that the type of energy infrastructure projects that we're looking to lend to are increasingly decarbonizing in one way or another. It's either green loans themselves, such as our Project Mirror deal that we did back in December, the Project Baxter deal that we just announced for the lithium-ion batteries, or they're loans where people are making investments in existing infrastructure in an attempt to reduce the carbon footprint of those assets or improve some way in terms of sustainability. So we have seen that opportunity shift, and it's not any surprise probably to anybody in your customer base, because we're really just following where our good customers are, and we like to bank the large energy investors, and they see the opportunity in these areas. They're putting dollars into these areas, and they're just looking for leverage. And I think our model for how to provide that fits well, because there still today aren't many folks that do what we do as purely first lien lenders to the energy infrastructure space. So it's quite a big opportunity, and we think it's growing, every year, every time the deal sizes get bigger. There's more room for us. Every time a bank retreats, there's more room for us. And I think that's just a growing opportunity set we'll see over the next several years.
Yeah, I think the only thing I'd add to that is when you are sector specific, you can come at it from a handful of different perspectives or different platforms. You could sit at a big generalist lender or asset manager and focus on one sector, or you can be set up, specifically just to, to bank that sector, if you will. Riverstone, all Riverstone has ever done is energy, and right. So when we set up this platform, what was essential to Chris and myself was to be able to create a lending vehicle that has sort of best in class valuation capabilities. And so when we sit at Riverstone, we sit at a $40+ billion, not just energy asset manager, but an energy company. And that's up and down the value chain. And so therefore we should be able to see trends before others. We should have in basin technology and information that you're not just going to get from reading a research report. We should be able to see the industry as it evolves, as it's currently evolving, and be able to say one step ahead. And so that's really what we do as a diversified energy company. We're the lending arm, and we're able to utilize all the tools that are sort of doorstep to pick and choose the right companies, the right technologies, the right trends with which to ultimately make our investments. And so, while we are sector specific and it is quite different, we come at it from I'd say a very strong vantage point with which to invest in that sector.
Right. Thanks, guys. That's a good introduction. I mean, maybe we'll just dig into sort of the actual loans themselves a little bit to give viewers a feel for the opportunity from an investment perspective here. What are the features of the loans, and how does that give you that IRR that you're looking for? And I guess just attached to that, looking at the kind of potential risks. A lot of people are worried about inflation and interest rates, and how would these investments perform if you saw rising interest rates?
Sure, I can buy it, Chris, and jump on in there. When we put the business plan together, what was imperative was that it wasn't an also ran, meaning it wasn't what everybody who was building a direct lending business off a generalist platform, whether it was a BDC or another large lender, was doing. It was not focused on cash flow lending, trying to keep money out as long as possible, 5 and 7 year loans. It was meant to be purpose built for the sector and for the companies that we service, right? And so when you think about our borrower universe, really, what is it? They're developing companies within the energy sphere. Energy, yes, it can be cyclical, it can be volatile, and so therefore you shouldn't meet it with the standard 5-year non-call 2 product or a 7-year piece of paper. Our thought process really was to create the bank that we always wanted to have and create the loan product that we always wanted to have. And so what we do is we set up our loans whereby we try to maximize the risk-adjusted return. And how do we do that? We'll start with the risks, right? You don't want to give a developing company unlimited running room. 7 years, you're prone to cycles, you're prone to all kinds of different things. So we focus more on short duration, 3-year tenors for the most part. And if you look historically, on average, those loans will typically come out within 18 months. What customers are doing is they're taking our money along with their equity, they're creating value, and hopefully they're outgrowing our cost of capital and paying us down. We embed structural enhancements to our loans to really incent them to pay us down. What do I mean by that is a typical bond has a declining call premium. It's non-call, and then it gets cheaper and cheaper over time to incent the borrower to keep it out as long as possible. We go the other way, whereby our loans will be prepayable, typically at par day one, and then they get more expensive over time. So our borrower knows that they're supposed to use our money and pay us back as soon as practical. Otherwise, it gets more expensive. It helps keep our IRRs either growing or flat over time as opposed to decreasing. But it's that behavioral economics that sort of says, listen, this is going to start to hurt more. This is going to start to cost more. And then we've really focused on value, loan to value, as opposed to an EBITDA covenant or something like that. Two key covenants. One is some sort of measure of value, measured like how would the market look at the value of this asset, and is the company continuing to maintain our loan to value? Are they improving it, or is it getting worse? And the other key covenant is liquidity covenant. How do companies get in trouble? They run out of money quickly. And so we measure those two things amongst other things, but it's those sort of structural nuances. And then the last one is probably delayed draw. We don't force companies that don't need all our money to have them draw expensive debt and park it on their balance sheet day one. We make them pay for the commitment, but they can draw it over time, and it's more expensive, obviously fully drawn, but maybe it's half the coupon when it's not drawn. But that gives them the ability to have a blended cost of capital, not take on too much debt at any one time unless they ultimately need it. Key to all this is our confidence in getting repaid and being able to redeploy the capital, which I think we've proved time and time again. The opportunity set is massive.
Great, and maybe on rising interest rates, how do the loans respond to that?
So the loans are all floating rate loans. So as rates go up, we actually benefit from that. There is a little risk, of course, that it gets too expensive for the company, and that sort of dovetails with the notion of liquidity. So we oftentimes will encourage our borrowers to hedge their interest rate exposure so that it doesn't get too bad. But from our perspective, it's only upside with rates going up.
Right, it's good to hear. We're seeing a lot of signs of inflation out there these days. Huh?
Certainly. Yeah.
Great. So, I mean, you touched on the team, Riverstone as a platform, and the team a little bit earlier. What do you think differentiates you guys in terms of origination? Ability to actually to differentiate between opportunities and pick the right ones?
Sure. So I think it's a combination of the team and our backgrounds. As I said, Jamie and I had been banking the energy sector for over 20 years, and really know kind of everybody there is to know, at least in the U.S. and in North American markets. And this is really, we're looking again to bank these projects that are requiring transformational capital. So we're very familiar with all these players, and they know us well, and we've done things together going back over decades. But you add that to the platform at Riverstone, which has, I think, unparalleled both breadth and depth across the energy value chain. We've obviously had a long history in the more conventional energy spheres, but we've been doing renewable energy for over 15 years at the firm. We've built the largest wind platform in the world, the largest biomass platform in the world. So we've got incredible insights into those markets. And then today, the firm itself is moving really strongly into the decarbonization sphere. And we see a tremendous amount of opportunity for our loans in that world, as traditional energy companies look to reduce their carbon footprint and make investments along those lines, and as new and more interesting forms of clean power, clean energy are produced, all of that is really right up our wheelhouse in terms of providing that transitional capital. And we've got a strong effort on that front on the equity side of our house, and we benefit from all of that. So I think lastly, It's not just the investment professionals at Riverstone, but we've got 2 decades worth of management teams out there that are either currently working for us or at least still friendly with us that we can reach out to and ping ideas off of, and we do that routinely. In terms of a new idea comes in, a new deal comes in, and we'll know exactly who to call in terms of getting a good read on it before we even lift a finger to do any work. I think, as Jamie said, we're not really reading research reports on this stuff. We're getting right into the operational, regulatory, geological risks that are posed by these things, and we're talking to experts on it that are in the house. So I think that is a pretty unique differentiator for us versus maybe a generalist that might try to do the same thing.
Yeah, great. And I was going to ask about sort of how affected you might be by sort of swings in oil and gas prices. And I know you've got the kind of the traditional sort of infrastructure side. The decarbonisation side, I guess, is just going to get bigger over time, so that will become a lesser impact. But maybe you could say something just about oil and gas prices as you see it today, and then going forward.
Sure.
Yeah. Hi, Jim.
Yeah, no, I mean, it's key to any successful portfolio is diversification, right? It's probably the first thing they teach you. If you look at our portfolio on any given day, what we really pride ourselves on, and we spend a lot of time volleying this back and forth as we're making investment decisions, is making sure that we are not overly exposed to any one commodity, any one basin, any one technology, any one end market. So, it's imperative that we are not an oil fund. It's imperative that we are not a gas fund, because that's a sure way to get yourself in a lot of trouble. And so what you find is within our portfolio that there are a lot of embedded natural hedges. And what I mean by that is, if we have a company that is exposed to an oil price, and oil prices go down, clearly not good for that company. But then we also have another company that may store oil and benefits from a low commodity price, benefits from a contangoed market that comes into play. You have one that balances the other out. And if you're only 25% exposed to some form of oil, whether it's upstream, midstream, downstream, what have you, and the rest is exposed to some natural gas, or it's exposed to all kinds of other things like helium or what have you, that also helps. But you highlighted, Rob, like we've moved over the years so much further away from the wellhead, where really the most exposure to commodity prices are. So the stuff that we're doing today in the last handful of deals that you've seen out of us, they're fee-based infrastructure type deals. So you're relatively insulated from shocks in commodity prices. Clearly the energy transition deals, the most recent deal that we did was a lithium-ion battery manufacturing company, community solar deal. Those deals are almost wholly insulated from some movement in any one of those commodities. But on balance, I think a higher commodity price environment does support us, does help us. But at the end of the day, what we can't have is any one of those commodities move the portfolio in any meaningful way. And that's really where a lot of the portfolio management activities and efforts are.
I think the only thing I'd add to that is that diversification is key, but generally more healthy commodity prices drives activity levels. So when prices are low, new infrastructure projects are harder to greenlight, right? So we do see better deal flow when the markets are more active and more vibrant, which is driven to some extent by commodity prices. What's interesting is that a lot of the things we're looking at these days are also hedges against higher commodity prices, in the sense that they are looking for ways, part of the decarbonization effort is to improve yields, improve the amount of production that's actually able to be sold versus what's produced, because you have, you know, big emissions problems are methane evaporation issues, right? So one of the things that a lot of guys are doing is they're trying to offset higher prices by essentially selling more of it and saving money that way, and I think that will ripple through to consumers and be very important. You know, the overall market for renewable energy is tied to oil prices to some extent, because the higher prices go, you know, the harder it may be to develop a newer technology to compete with it. So, you know, as prices come down or costs come down in the renewable market, you're going to start to see people, you know, using that as a replacement for oil because it gets too expensive. And I think we're going to benefit from that as well in a hedge-like fashion. So, you know, we're constantly focused on those prices, but it doesn't really impact the portfolio day to day, but it does drive flows to a great extent.
Right, that's very clear. And in terms of the fees on the vehicle, then it's a little bit different to many closed-ended funds in the way you have structured the fees. Could you maybe just let people know how you're doing that and what the reasoning is?
Sure. We designed the fee structure to make it clear that we wanted complete alignment with our shareholder base. So we set this up so that there are no fixed management fees at all. And all we earn is an incentive fee, which is paid through a waterfall. The first 4% return is 100% to the investor. The next 4% on top of that is split 80-20 between the investor and the manager. And above 8%, it's split 70-30 between the investor and the manager. So we don't really make any money unless the investors make money. I'd say that all the incentive fees, though, are also tied to a high water mark, which is essentially having the NAV be above the IPO price. So we can't be paying out distributions to reduce NAV and still get our incentive fees. So we have to both keep the NAV above that point and also achieve those yield hurdles to get paid. And this has worked well so far, I think. I mean, we're not pleased where the stock price is, but we're very pleased where the NAV is, and we're working very hard to collapse the discount between where the share trades and where the value of the portfolio is. And I think we've got some good things coming in the pipeline that will continue to assist with that.
Yeah, and Rob, I think when you think about it, right, new guy on the block, new type of product for this market, sector specific, where the sector has certain connotations and preconceived notions and what have you. Our thought was, let's put our money where our mouth is to a certain extent. Let's create ultimate alignment with the investors. Show the investors that we will do what we said we would do, and I think that's proven out over the last year, especially given how turbulent the markets have been, and then grow with the investor base. So it's an education process, which is why having folks like yourself alongside of us and helping us get the message out to investors that this is a unique way to play the sector. We have a unique vantage point, and I think a unique way to really make above average risk adjusted returns. But we knew that we were going to have to earn that trust, and hence the I think relatively novel fee construct. But I do believe our investors can make a very nice return off this construct, and I do believe we can as well. And the key is, as Chris highlighted, is getting that stock price to reflect the NAV, to reflect the distributions, to grow. We need to grow. Our opportunity set far outweighs the capital that we have to deploy. So, we're on it, and I think we're making good strides.
No, absolutely, and I think the other kind of shareholder friendly element is, Yeah, as you said, you know, the stock is trading at a discount right now, and there's definitely an opportunity there. I know you're using pretty high discount rates to value the assets in the fund, in the double digits typically. And then given the discount, you've actually been out there doing buybacks. I mean, what's the policy around buybacks and dividends?
Well, dividends is easy. We pay out 100% of available cash flow every quarter, and we are obviously incented to do that with our fee structure. So there's no benefit to either us or to you to hold back cash or whatnot. So we do pay that out. In terms of buybacks, I think it is there's a formal discount control mechanism in the trust that requires a certain amount of portfolio cash flow to be used to repurchase shares over a period of time. But remember, portfolio cash flow is really principal repayments, not necessarily income from the trust. And I think we didn't follow that to the letter of the law during COVID, mainly because there weren't a lot of portfolio cash flows to be had, but we did use cash in the trust to do some buybacks. And we bought back, roughly 9 million shares over a pretty extended period to try to help reduce that discount. And I think the way we look at it is investing in the share more accretive than making a new loan, because as you know, the trust is relatively small, and we don't want to deplete the cash too much. It already is subscale from a liquidity perspective. So right now, I think we're balancing where it trades and where we're able to make new loans. And as you mentioned, we're paying a 9% distribution on the current stock price, but we're making 12 or 13% loans in the market, and the most recent one was even higher returning than that. So we think it's better for the shareholders for us to keep deploying that capital into the market, and that will ultimately ripple through to the dividend flow and improve hopefully where the shares trade. So, but that's not to say we wouldn't resume a buyback program if the stock dipped. I think we'd absolutely take that to the board for their consideration. But right now we've put a pause on the repurchase program, and we're just kind of trying to get the capital to work as efficiently as possible.
Yeah, I mean, that makes sense. I mean, as you said, there's a huge demand for capital over several years in the energy space. Yeah, there should be plenty of opportunities for you guys. I mean, just coming on to sort of what you've been doing recently, you released your portfolio update 2 or 3 weeks ago, and I was looking at the portfolio returns, and you're getting quite high multiples on some of your unrealized investments now. I was just interested in why the returns seem to be getting better actually as you're getting along.
Market's getting better. I guess there's a handful of different things. One, we've had some very nice realizations even throughout the COVID period. And I think that's a testament to the structuring, to obviously picking, the right horses to back, if you will. But, when you get into market environments that are challenging and your borrowers have the support from their equity, or they have available capital at their disposal, and they say, listen, I'd much rather pay down my first lien lender than have to get into an issue with my first lien lender. Or in other instances, they've actually just even improved through this market and can take us out of the cheaper cost of capital. That's obviously great. And we're, while, money coming back, puts the added onus on you to redeploy it. It highlights to us we made a successful investment. So there's been that, and that's filtered through to our investors. The other part of it is, as we look at our valuations and how we look at the unrealized positions, those are we do all that third party. We bring in Houlihan Lokey, which is a very established name in the valuation game, and it's kind of call it level 3, type valuations, right? It's for illiquid assets, and a lot of that, most of them are tied to discount rates that we glean from where the market is. What are the trading levels in the energy high yield or the institutional loan market? And clearly through the COVID period, the risk premium, the discount rates, gapped out tremendously, weighing on our unrealized positions. Today, those markets have improved. The valuations of our companies have improved, and you're seeing that filter through into the marks. And so we're in a very we feel really good about the period that we're in. We feel really good about the portfolio itself. The recent deals and the pipeline. I think you highlighted it, right? We're coming into an incredibly fertile environment for new deal activity. The amount of capital available for energy transition and for energy infrastructure is large, and that is excellent, because it's going to push forth projects. And it's going to help the market really come up with new technologies and new ways with which to greenify the environment, to make our energy more efficient, effective, what have you. And we're right there, as we were with old world energy. We're going to be right there with new energy for those projects, those non-traditional projects, those bridge type loans, those project style deals. And so there's a tremendous amount to be done, and we are pleased with the marks, and we expect more upward trajectory.
Rob, there's a time element too, right? The more coupons we collect on a name, the higher the MOIC will go. So some of these loans are getting higher and higher just because we've collected more and more coupons, and they've just been around a long time. So a lot of it just been on the duration, but generally the unrealized values have come up, as Jamie said, and we've also just been fortunate that all these companies continue to perform and pay their dividend or their coupons, which we collect and then send out to the investors.
Absolutely. Well, great. That's been a really helpful review of what you guys are doing. It sounds like you've got a great environment and are continuing to generate those high returns on those loans. So with that, I'd like to thank Jamie and Christopher from Riverstone Credit Opportunities Income.
Well, thank you,
it's our
Rob,
pleasure.
Charlie. Thanks for your time. We'll be talking soon.